Good morning, everyone. A little update from Florida and then down into charts of the week. Let's get going here. So we own this mall in the fund. It's called Crossroads Square. Address is 8102 Blandling Boulevard in Jacksonville. So kind of a high-rise picture here from the drone. All of these numbers are as of 12/31/24. And NOI came in at 1.35 million, which is above forecast. And there was a couple of things going on the lease renewal side, so we'll just sort of talk about that. As well as the mortgage there. Cash flow was 124,000, and that cash flow was a little bit lower than in prior years, primarily as a result of one-time expenditures related to the demise and retenanting of one of the suites on the end side that was vacated by Office Depot, and that was a big box. About I have the numbers somewhere, but it was a bit. The main thing from this chart, so you could see Office Depot was 23,000 square feet at $9 a square foot. $204,000 in base rent has essentially been not only replaced, but after year one, kind of juiced up by call it 1.5 times with this tenant called Kids Empire. The vastly more important tenant, I think, is that Sonita's primary and urgent care clinic, because not the sizing, it looks smaller, but with Sonita's, they're actually putting in about $3 million to build out the gray shell. And with these medical kind of places, there's more specialized like HVAC and X-ray and plumbing requirements. Sounds like Sanitas is gonna pump some money in here, which is good. And it's good because the 5,000 square feet or whatever it is doesn't sound like a lot, but these medical, and we've talked about this before, these sort of medical healthcare related tenants are much stronger than, with all due respect, a hair salon or something like that. And they rarely relocate. So it's good to have a nice kind of nationally recognized profitable business moving in. Floors and decor. So this is pretty important. So in February, like this past February, F&D basically executed their second lease renewal option, which extended the stay until 2030, which you can see there. And the rent is going to increase by about 85,000 a year. The partnership actually approached Floors and Decor with a 15 cent per square foot reduction to the $1 per square foot pop up in exchange for renewing its lease just 6 months before the expiration date. The issue here is that Floors and Decor was not able to accelerate the lease renewal process to meet the new mortgage that the LP had to get. And actually, this is one of those mortgages where the general partners had to personally guarantee the mortgage, and that's just sort of an issue of recourse versus non-recourse. But Floors and Decor, basically to kind of summarize, Floors and Decor did execute their lease renewal option, and the plaza was able to secure a suitable mortgage without incurring any loss of revenue or that sort of thing. So that's nice. And with the new tenants, again, Kids Empire, maybe Kids Empire kind of under or discounted a little bit too much, because again, healthcare in terms of Sanitas and childcare type of, not that really this is child care. Just to be very clear, Kids Empire is not a babysitting company. It's a play place, like where you take your kids into these rooms that have like jungle gyms and all that kind of fun stuff. So it's not really, in my opinion, in that sort of need to have tenant base. It's a nice to have tenant base. It's something, it fills in the box. But the bottom line is, looks like the annual income is going to go up by $200,000, which we like. And so here again is just the summary of Office Depot being replaced with Kids Empire and Sanitas, and then the incremental bump, essentially the $1 increase from Floors and Decor. And they've got 5,000 square feet left to go. So if anybody on this call wants to open up a store at Crossroads Square in Jacksonville, Florida, please let me know. I'll put you in touch with the partnership, and maybe you'll get a deal on the rent because you know me. So there you go. Okay, charts of the week. Pretty good bounce late last week and into Monday. Andrew Adams And by the way, Andrew's partner Jeff Sott unfortunately had a fairly substantial medical event occur, so we're very keeping Jeff Sott in our minds and stuff. From a technical perspective, it looks to be the case that the market was again kind of heading to this really big overbought level, and Andrew, for his part, thinks that this strong buying does suggest that the market is trying to push higher and maybe get through this quagmire of Trump kind of talking out of both sides of his mouth. We don't get political here, but that's that. And you did see some selling off later. So here it is. So pretty good downhill run. Actually, I was in Tremblant last week on March break, and there's a ski hill that there's one of the runs looks like this, but you can see down here at the lower end, it kind of hit that lower oversold line, and then popped back up a little bit. Unfortunately, it's looks like it's heading back down to that, more oversold region. So we'll have to kind of watch that. I guess, on this chart, the stock indices are kind of, it is what it is. Gold has done really, really, really well here. And we were just on a call with one of our hedge fund partners who, he's American, good, young, smart guy. He thinks maybe gold kind of takes a little bit of a breather here, not tanks, but that's quite a nice little pop. And then crude oil, someone smarter than me has got to explain it to me, but I would have thought that kind of with the resumption of, let's call it hostilities in the Middle East, you might have seen a pop up in crude. So I guess I'm just not understanding maybe something wider than geopolitical risk, but and then US 10-year is the US 10-year. So that's, it is what it is. Looking at this section of kind of, internal market indicators, I think the risk on, risk off one is really the one you got to focus on. So basically what he's done here is he's just compared utilities versus the NDX, which I think is the cap weighted top end of the NASDAQ. And, it's really all utilities at this point. I think there's a Mag 7 slide coming up, so we'll get to that in a moment. From a relative or comparative week over week sector ranking, the big mover down is these consumer staples here, -7. That's into the red category. So consumer staples, moving off quite a bit. And actually, on a side note, I did notice, I don't know if it's just myself, but I did notice more in the way of closures and layoffs. So not just the Bay, but Forever 21. And then it sounds like Morgan Stanley is kind of doing a little bit of house cleaning as well. So we'll just have to monitor that, because those are decent jobs. But anyways, consumer staples -7. Looking at the S&P 500, it did kind of have some slippage here. There's now several, I guess, zones of overhead resistance, which is a bit of a concern. Obviously, if you get sort of cooler heads prevailing geopolitically, those could be breached pretty easily. But there are these support vacuums down below, so you just gotta keep an eye on that. And we've just sort of been having the same, narrative with our investors, which is, probably everything's okay, but just be aware of your surroundings. This is that likely retracement window. I can't really comment as to whether, this is a very broad or wide window. It looks pretty wide to me. And then this heavy selling from around this does increase the risk of another leg lower. So it could be more of a case of, investors see something they don't like or something they think they might not like, and they just, rotate out of stocks into TLT or some of the bonds on the treasury side. Mag 7, so pretty good shakedown here with the big, tech titans off 20. And, he didn't, he was very careful in the write-up. You'll notice that lower panel, the RSI, has transitioned from negative into going back into the positive, but he kind of fell short of saying, okay, it's time to load up on the Magnificent Seven. Sentiment. So negative sentiment supposedly is one of the hallmarks of a bear market. And while sentiment can sometimes be a contrarian indicator during the worst periods of history, investors tend to remain negative throughout the entire decline and even for a little bit afterwards. So you can see here some pretty obvious red zones. So just to explain, the lower panel is the S&P 500. The upper panel is these AA investor sentiment surveys. And so it looks like a an earthquake monitoring graph with these needles kind of spikes, but there's some persistence there. And so he kind of concludes that sentiment, like seasonality, should again be one input and not the be all and end all, and really to just sort of follow trends in pricing. And for a technician, Andrew's always been really, really good at not getting too seduced by just a single chart or something like that. This is the North American Active Investment Manager Exposure Survey. So it's come off. There's still long equities. It certainly doesn't look as bad as you would think. And again, we talked about this with one of our hedge fund partners earlier in the week, or it might have been last week, but there seems to not be as much media coverage associated with the decline in stocks as there sometimes can be. Sometimes when there's a sell-off, it's like that's all they ever talk about, and you're not seeing as much of that. You are seeing it, just not as much of that. Okay, gold. So, the issue here is that it's done very, very well, but he kind of feels that, it has in certainly the near term reached its upward price objective. That's not to say that over the long term it could go higher. We all know it can. It's just that, in this recent last couple of sessions, it's moved pretty good. And for the record, he thinks it could hit 30.50 pretty easily. Again, expect some potential volatility there. And then just finishing off with, I can't see it here. Oh, Bitcoin. This is the Bitcoin chart. Yeah. So obviously Bitcoin and a lot of the layer 2 applications just got annihilated in February. So I know, Dave, you're going to be at a conference potentially regarding that and might get some more intel. Sounds like sort of a, the kind of meat and potatoes correction for the cryptos. Again, these are more volatile, investment instruments, digital assets, whatever you want to call them. So these are not, I don't think anybody goes into Bitcoin or a digital asset investment thinking, well, I'm buying shares of AltaGas. It's just not the case. So a lot of noise around the pullback in cryptos, but it certainly doesn't look like anything that this space or investors in this space haven't seen before. And that's it for myself.
Okay, so normal Thursday report, March 20th. Same disclaimer as Joe at the front end. Just going into it quickly, be pretty quick. S&P 500, bit of a reversal. New support line there, the top red line. Vertical price objective still remains bearish. Overbought, oversold, still pretty oversold despite the kind of bounce we've seen the last 2 days. At 63% oversold. That's the third straight week it's been oversold by over 60%. That's the first time in 2 years that has happened for the S&P. So still some lack of demand there when it comes to the S&P. Same story here for the NASDAQ in terms of overbought, oversold. Oversold at about 69%, which is a slight increase week over week, but it's the third straight week it's been oversold by 50% or more. Last time that's happened, October 2022. Price objective did move up this week, though, up to 21,000, which is bullish. It is important to know the NASDAQ is trending negatively, just like the S&P under this trend line. So something to watch there. Obviously, some continued tech worries. Tesla and Google, kind of the two companies that dealt with the more worries this week. Alphabet made some big acquisition for apparently a high multiple for the tech startup that they acquired, and then Tesla, some of their market share look like it could be dwindling in China moving forward. Just clicking here to the Dow, 6-box rebound week over week, negative trend end last week, created a support line, which is a positive sign. You can see where the resistance is right now, up at 43,000. So some upside to move to get there and return to a buy signal for the first time in over 8 weeks. It is only down, the Dow, 1% in 2025. It's outperforming the growth indices. The chart just looks a little nastier because of the larger rise the Dow went on at the start of the year. Price objective 39,800, which is bearish, and would be all the way down here at prices we haven't seen since August, which is only 6 to 7, 8 months. So the large drawdown that some people are talking about has not occurred yet. They're a little off with their characterization of what has happened. Weekly overbought, oversold, 54% oversold, slight increase. The first time it's been oversold by 50% or greater 2 weeks in a row. Since October 2023. Just flipping here to the TSX 60, 4 box increase week over week. It has created some nice strong support. You can see at these two lines. Surprisingly enough, the TSX is up year to date. You can see here it's actually at the same level it started, where that one is, started 2025. The tariff worries, Canadian equity market is kind of hanging in there, and I'll show a slide at the end that depicts a picture of another country's equity market that's doing the same. Overbought, oversold on a relative basis, much stronger. Still oversold though. North of the border, it is the third straight week it's been oversold, which is the longest negative streak since June 2024. So something to watch there. Obviously, some of the commodities continue to still hang in there. Price of oil obviously not being one of, now trading in the high 60s. So perhaps some flowing north based on multiples, based on the value oriented stocks that we have up in Canada that haven't gone on as large of a run compared to the US in markets last few years. Just looking at the VIX here, two sell signals this week started to break down a little, 11% target now. Bit of a slowdown in volatility for the first time in a few weeks. Really, the first week I haven't seen major headlines on Trump's tariff policies or him walking back tariffs. So that I guess is something. However, one of his I think his Secretary of the Treasury, Scott Besson, did say that countries around the world will get their tariff number on April 2nd, whether that be a percentage or dollar value. I'm assuming a percentage of some sort. So just a few more trading sessions until that date. In terms of the bullish percentage chart, S&P did not move this week, still moving upward to 40%. NYSE dropped another 2% to 32%. It's at its lowest point since the end of 2020. Something to watch there if it does slip past this official bearish territory line. It is interesting that these charts are particularly the NYSE one on the right here, are sitting at 32%, almost in bearish territory area, and we've only seen a 10% drawdown. So you can obviously, these technical indicators continue to reflect what we all know, that markets were really carried the last couple of years by a slim number of names. Looking here at the percent positive trend, these two both breaking down. The Dow on the right, though, really elevated comparatively. I mentioned the value index performing better, but on a relative strength basis and in terms of some technical indicators, a lot more strength. No changes to these Canadian indicators, so I'll flip. It's been about a month and a half since they changed. Domestic equities this week, second straight weeks lost buy signals. It's lost about 20 in the last month. Commodities continue to gain. International equities took a bit of a pause, but has picked up buy signals over the last few weeks. Within the commodities area, energy lost one buy signal, but agriculture gained 7. So perhaps time now to pick up some agriculture stocks, or even in the futures market. I mean, Powell warned yesterday regarding inflation. If we really do get a full-on trade war or increased tariffs and less trade globally, we could see a second wave in inflation. I think already in Canada, the level of inflation picked up last month for the first time in over half a year. So something to watch there. Just a volatility chart kind of to look at. This is a number of 10% pullbacks for the S&P by decade. And then these red dots are the average days between those pullbacks. We're actually in the 2020s, even though we're not even 60% of the way through. We're just barely 50 priority time, the 2010s, and then basically right at the same level as the 1990s. So if Dorsey Wright wrote up, if the decade continues like this with the pullbacks that we've seen, could set a record if you take out the 90s and surpass the 2000s in terms of 10% pullbacks. But it is important to note, obviously, that indexes have also regained all the losses that they've had in the 2020s. Well, the 2000s, it was a bit about a flat decade when you really think about it. I'm just looking here. This is kind of just talking about the chart I just showed, the 10% pullback. So this is the major asset class returns after the S&P 500 pulls back 10%. You can see those 6 major indices all up a year later, all up 6 months later, and even all up 3 months later. The best performing area, Russell 2000, and then the emerging markets, uh, followed up by the S&P 500. Historical averages show obviously that these 10% pullbacks are healthy, and that's what a lot of market strategists have been kind of echoing right now. But we'll have to see if it is the bottom or if this pullback kind of continues. Just wanted to highlight this chart. This is the EEM ETF. We scooped up some of this exposure a few years back. It moved higher kind of immediately, and it looked great. And then it pulled back. Obviously, there was some weakness tied to the Russia-Ukraine war. Then there was some weakness in Mexico, and then there was some weakness, obviously, caused by China and China's largest exposure in this ETF. But on a relative basis, it really picked up last year quietly, had a strong return. Right now, the fund's scoring at a 4.18 out of 6, just popping above its negative trend line. So really looking to break above that $47 marker, because that's the multi-year high resistance. And we're really happy to continue to be holding on to it in a number of accounts right now. We think the growth is going to be strong there. Didn't even mention India. India's stocks really melted up over the last few years and had a bit of a reset over the past 8 months, we'll call it, pulled back pretty heavily. And now they're at their lowest PE ratio in, I think, about 3.5 years. So something to note there. And then on a relative strength basis, EEM just turned over, looking to create its first relative strength buy signal since July of 2020. Something to really watch there. On the developed front, European equities continue to surge. This is the European financial ETF that trades for my shares, basically a perfect score. It's already up 27% year to date. Dollar price target, basically. So a bit of an upside from the $29 price it trades at. A number of these firms obviously surged after a few years of basically running flat. I'm pretty sure there's one or two of these European banks that are in one of our US models, but I'd have to triple confirm that. But nonetheless, continued and sustained strength we've seen over the last few months in across Europe. This is the index, obviously, I was wanting to show earlier when I mentioned Canada. It's kind of pushed off these US tariffs, and stocks are about flat up north of the border. South of the US border, it looks even better this year. Despite the tariffs, this is the iShares EWW, created 2 straight buy signals after a pretty tough, like I said, last 6 to 7, 8 months of 2024. Now, we still own some of this ETF. We bought it, I think, way back in 2022. It's not like we're down, but it's had a bit of a reset, like I mentioned. But we continue to think there's going to be a nearshoring. There obviously will be an impact from tariffs, but for now, it really seems that the Mexican government actually has we'll call it handling Trump a little better than some of the policymakers across Canada have handled the tariff announcements on the original announcement, where the Mexican tariffs are, for some reason, the first ones taken off, and then a couple hours later, a day later, the Canadian tariffs have been taken away. Looking at the Indian market, I mentioned this earlier, a lot of emerging markets right now. Like I said, trailing 12-month PE is the lowest since mid-2022 for the Nifty 50. This fund is the INDA. It scores at a 2.48 out of 6, so not great. You can see the massive pullback, though, basically from $59 to $48. That's at a $12. It's a 20% pullback since right before the US election. Now trading at the same levels it was trading at in January. Remember, they had this crash here in June was due to their election having some issues and people worrying Modi wasn't going to win. I think they had to go to a second round or something like that. And then the market surged back up. But it did seem like the Indian economy was overheating a little last year at the end of the year, but the Indian market really was trading quite expensively, especially for an emerging market. But now we've seen this pullback, and there's a little more value there. I'm just highlighting here, this is the US federal government's spending versus tax revenue since 2015. Even though it's a different party right now, still the same lack of fiscal discipline, Over the last 10 years, government tax revenue has increased by 60%, which is great, but spending has increased by 98%, which has caused obviously the national debt to surge to 36 trillion. Now there's about 7 trillion maturing in US debt. They want the long-term interest rates in the US to decline so they can refinance at a lower value, at a lower interest rate, but we'll have to see if the Fed can follow what Trump and Scott Bessent and the bond market in the short term have kind of showed that they're pushing for lower interest rates. And then last chart, gold set a record high price, well over 3,000 now, continuing to show investors stability, protection, and quality. Obviously, the miners talked about it in depth recently, and just the multiples they trade at. We think it's still a good space to be in, even if the price of gold moves a little horizontal comparatively to the last year and a half. Gold miners have some upside, and we think they'll have a strong year this year. And that's it for me, David.
Thanks, Ken. So my internet's a little challenged here, so I'm using my phone for the audio. And I think I'll keep my camera on just so that things have a leg. And let me start with a video. Hopefully this works. Please tell me if you can't hear this.
Hello, everyone, and welcome to this morning's brief update from March 20th, 2025. My name is David Clark. I'm one of the analysts here at NASDAQ. Yesterday's performance was positive for most of the indices we follow on the video here. We saw the Russell 2000 lead the way to the upside for U.S. equity indexes. Only thing in negative territory was that currency index as it moved opposite the dollar with yesterday's action. Taking a look at the chart of gold this morning, we see that it eclipsed the $3,000 level earlier or late last week, and then ultimately with this week's action, it's moved above that 3,050, pushing towards the top of the trading band there. Then looking at EFA, we actually saw it rally up to 85, marking a new multi-year high, putting it one box below its all-time high from October of 2007 there at 86.50. So we'll continue to monitor that. And as for NDX, we did ultimately see that it was able to reverse back into X's here in 19,900. With a move above 20,000, that would be a second consecutive buy signal for NDX. The NASDAQ composite saw similar chart action. And then from there, when we look at other U.S. equity charts, we saw some continuation in the current column of X's like that of the Russell 2000, moving above that 2080 level in that current column of X's. And then as far as indicator action, we're continuing to see stocks maintain or at least move back to buy signals, as with the bullish percent for the NYSE reversing back into X's here at 38%. So at least that initial move that we're seeing stocks return to buy signals, along with other indicators that we've noted, have moved positively, such as the high-low along with 10 weeks rallying. So we're seeing some of that near-term return of demand. Now looking at stocks this morning, as far as earnings go, Five Below's moving higher and currently trading at 82 after a beat. At the moment, sort of continuing that current climb in that current column of X's coming out of oversold territory. We've seen a series of sell signals. At this point, the stock has fallen down to lows we saw last in August of last year, and currently rebounding off of those lows. We did see it reverse in or give a market RSL signal during last week's action, so I've seen notable technical deterioration there, but with a rebound now after earnings, and then earnings upcoming later today, going to be FedEx, FDX. Consecutive sell signals here, with the most recent being a triple bottom break there at 244. Took out some of that support there as it moved to 240. We'll now monitor support in this $220, $230 range. 224 as well as 228 and 236 is where those support levels lie for FDX. At the moment, reversal back in X's occurs with a move above 252, and a return to a buy signal would occur with a move above 268 there. But FDX, one for fiver. Lennar, LEN, also one for fiver. This one moved into a negative trend back in December. We've continued to see it move lower at this point, moving back to a sell signal with recent action with triple bottom break there at 116. I've seen it sort of consolidate here after it fell pretty oversold territory, but at the moment, not much support close by. As you see some there at 104, but then we're working down into the 90s for the one for fiver. So maybe keep an eye on that. If you get a bounce, they take an opportunity to exit. Micron MU, a 4 for fiver after reversing back into X's last week on its pure RS chart and also flipping that trend back to positive. It did that so after it returned to a buy signal, currently sitting at 104. It's been consolidating within this 110 to kind of mid-80s range for really since December of last year, actually going back even further, looking back towards August of last year. So I've seen pretty notable range bound out for MU here. At the moment, it takes a move above or those mid-1 teens, move above those mid-1 teens in order to clear that resistance on the upside. But we do see pretty significant support there in the mid-80s for MU as well. And last but not least, Nike reporting after closing a 2 for $5 recently returned to a sell signal, currently testing that bullish support line, which would be violated with a move below 71. And then we would also monitor support at 69, move below 68 would be a new multi-year low. And we've seen some resistance build up here in this $80 level. So if we were able to see a move above that, that would be a near-term positive for NKE. But that'll wrap us up for today. And as always, if you have any questions about the video, feel free to reach out at 804-32.
Okay, hopefully that came through loud and clear. Those some interesting messages there. And now I'll go through Michael Coolbaugh, who, as Joe said, we met with earlier this week, and let's see what he has to say. So the S&P breadth readings, short term, finally hit an oversold last week, but as the chart demonstrates, durable bottoms for more powerful rallies don't tend to occur until we see the black and red lines. Also hit oversold readings as well. So, yeah, might just be a false bounce here. Ken's talked about this on the VIX, and that reading this low is typically good for a bounce. We saw a similar trend in early 23 and August 24. We all know what happened after August 24. It was a terrible. Oh no, that's 22. So yeah, actually August 24 is a great starting point. Investors turning cautious. Our first reading of oversold sentiment since the Durban bottom in late 2022. Don't forget, we first hit extreme bearishness in Q1 of 22. And there was still a lot of pain for the bulls. Yeah, 22 was a terrible year, and 23 wasn't such a massive recovery. We'd still be talking about 22, but 22 is forgotten. So year-to-date price return. So you've got the recent pullback has seen valuation multiples contract from record levels. Part of that is due to EPS estimates rising. Now that's not a growth story. If EPS doesn't live up to the optimism, valuations aren't as they appear. A big drop in vacation intention, especially in Canada. Non-political softening. Obviously, the Democrats' response weighed on this result. However, it's worth noting that there was a noticeable downtick across all political affiliations. Yeah, that's fair to say. Again, hard to say this isn't impacted by political bias. However, if there's a silver sliver of truth to expected changes in unemployment, there's a lot of downside risk for payrolls in the coming months. Yeah, if there is a recession around the corner, then you're going to see more unemployment rising. A drop in discretionary spending. It's not just airlines, and it's not just survey results. The hard data shows consumers are pulling back on discretionary spending over the last few months. A wealth shock with household equity exposures at all-time highs. Yeah, so that's coming off from all-time highs. Nasty chart, but it says a lot. Theory of reflexivity. 3 14-point out on that terrific graph. Households hold a record amount of their financial assets in the equity market. And this does introduce George Soros' theory of reflexivity if the decline in markets persists. Okay, and that is it for Andrew. And I'll have a quick look at the morning coffee that just arrived. So this will be a first. Tesla, more bad news for them. Recall of their Cybertruck. Yeah, bad news for them. And more tariff threat, Canadian lumber. Okay, supposedly Carney's falling its snap election April 28th. Okay, there's a bunch of things to digest there. I'll do that later. So there's a gold miner with insider action, and let's just look at the year-to-date. So back in the green for Canada, whereas the U.S. is still in the red with the Nasdaq down the most, down 8%. Europe continues to look strong, all green throughout the year for the most part. And India looks like it's starting to turn green now. Oil's come off, and it's had a terrible month, so negative for the year. Nat gas is still looking very strong throughout the year, as does gold. Mostly silver and copper for sure. So commodities are holding in the commodity complex, and I don't think there's really any change in the interest rate structure, but I'll point that out when it comes to bigger numbers in a moment. Yeah, so nothing new there in those headlines from my perspective. Yeah, I don't understand the logic of cutting rates when you think as the president thinks he's improving the economy. That's really inflationary, and that's madness. So inflation is still going to be a problem, in my opinion. And come back to that when Ross and Gilbert talk. Finishing up here, back to the playbook. And once again, the Canada-US dollar looks the same, still the same downside risk. Same thing for the US dollar. It looks like it's bottomed out here over the last couple of weeks. So it'll have to find some new direction now or just go sideways. And pretty much covered everything else. The oil downside, nat gas is downside. Producers measure up. And uranium, that's new, but that's measuring up again. That's a change. And these gold numbers are new. So the futures measure up to almost 3,400 and the spot to 3,300. And the gold bugs are up. So these are matching finally. So both the MX Gold Bug Index and the VanEck majors are both measuring up. We really needed the majors to start to show some uptick here to catch up to the commodity price movement. And meanwhile, the juniors look to be level. Silver up across the board, including junior silvers. Yeah. If you own some precious metal stocks, just sit on them. They should be on a good run now. Platinum down. Bitcoin measures way down. Yeah, this is going to be an interesting conference on Monday. I'm attending a conference in Miami put on by a new fund we're investing in called XPAM, run by Raoul Paul and his gang. It's 12 crypto managers who go everywhere from long-only Bitcoin holders to those who trade Bitcoin and Ethereum and others, and those who trade in around these altcoins, which I don't really understand, but those guys are the gamblers of the world. But we believe by having 12 of them together and they're actively managed, it'll take out some of the risk in the industry, especially if it goes into a, as they call a crypto winter, meaning a bad period of time. We're sort of in neutral territory right now when it comes to crypto. So anyway, it's going to be interesting. Should learn a lot and meet a lot of people. Okay, interest rates look the same across the curve. Yeah, nothing. Maybe the 30-year has come up a bit to only down to 4% to target from 4.6 where it is now. Yeah, so that's saying that that inflation has been defeated, but we don't think so. At least I don't think so. So we'll see what happens there. And that's it for me. So Ross and Gilbert, let me get you onto your screen, and you can take it away.
Good, David.
There you go.
Okay. Right off the bat, you can very clearly see what's going on and why it's going on. The Standard & Poor's 500 did they get right up to that top yellow line. That's 4.5 times book value. And as I've told you a number of times, that was the peak of the market in the year 2000. It retraced all the way back there. It is now setting back. It has had a good setback. Probably more to come, but let's have the next chart, and I think it'll be a little bit more obvious where things are going to go. So the Nasdaq 100 is the next. Yeah, there we are. Okay, and you can see a good, a big setback here from the Nasdaq. And if you look back on this chart, from the beginning, you'll see that every time that the index hits the next break point, it's what we call its bubble price, or 7.4 times book, there has tended to be a nice rally, and we got about 10% to go there, and then the Nasdaq will be down there. We should get a nice tradable rebound at that point. Yeah. If you got cash, hold on to it for a bit. Watch the Nasdaq, and as I say, there should be a nice rebound right there. The next chart is the TSX, and it's set back to, of course, under the weight of the U.S. market. It couldn't do anything else. But however, within the TSX, obviously there has been some the goals have held up and are breaking out over the 3,000 mark, and I think there's some good upside potential there, particularly as U.S. investors have yet to quote unquote discover gold and gold stock investments. Are some companies, some junior companies, we note in particular that have they're very cheap. They have very good balance sheets. I look for the ones that have growing, strong and growing reserves, which makes them all the more attractive for acquisitions. And anyway, we're looking through and finding some of those companies. So opportunities there, and of course the utilities have been moving up thanks to the Bank of Canada bringing rates down and bringing them down, I think, even more recently. This is a market, I think, very similar to 2000, where for the time being there are places that you can hide and indeed even make money. And in the year 2000, the golds did well, but the value stocks kind of came into their own as the high technology stocks set back and got hurt. There was some room here to go. That brings me to Grant's interest rate observer for March the 14th. And there was a couple of interesting articles in there. The one on the very last page, back page, was entitled "Fireworks Show Delayed." And he starts off and points out that the most remarkable aspect of this year's sell-off is its orderliness. And yeah, the market's down, but where is the wailing and gnashing of teeth? Doesn't seem to be there as of yet. Well, that's great, because that means that as the high techs get hammered, then investors are still looking for opportunities, still looking for value. And again, that's very much what happened in the year 2000. There was an article on investing in emerging markets. If you're interested in that kind of stuff, you can read it. But the other article in Grants that really caught my eye is entitled "Buildings in the Slow Lane." And they talk about commercial real estate in the States. And then certainly in some cities is getting hammered. And price reductions are coming down, and particularly for B and C class buildings. That's not the only aspect of commercial real estate, however, that's getting hurt, because buildings are getting hurt as well. So as delinquencies increase, by the way, that means that there is tremendous pressure on the banks, and of course the community banks, the regional banks in particular. So if there's a warning from Grants, it's beware of commercial real estate and apartment real estate, but also be alert to the fact that the community banks in particular could get really hurt. Just to finish off, I would refer to the last page, "Fireworks Show Delayed." There's one other area of the American market that is getting hurt, and that is to say that private equity is in some areas is getting hurt as well. And he points out that promoters are slow to mark their portfolios down when the market lurches lower. And they talk about KKR, Apollo, and Blackstone. All their stocks have been hurt quite a bit more than. So anyway, an interesting article and an interesting issue for those things. So anyway, David, that's all that I want to say, but I would like to pass it over. It was quite a long discussion, and I think that we'll turn things over to David, if you don't mind.
Yeah, that's fine. Thank you. That was a great update. Some really interesting slides there. And yeah, I just don't see how a recession is unavoidable, unless some government politician steps in and changes the rule, like literally changes the definition of a recession. And that's what happened last time when I believe we did go through a recession. It just doesn't show up on the charts.
Bye, everybody. Thank you very much.